Ladies and gentlemen, Tesla had a monster day today, and there are signs of what could be a short squeeze and or gamma squeeze in the short term that could be coming to the stock. Let's face it, just the facts are the facts. The stock fell from $488 per share down to $217, a drop of over 55% in about 2 months. The fastest ever decline in Tesla. Is the pain over with? Your guess is as good as mine, because it comes down to, do we go into a recession or not? But in the short term, could you retrace a fair bit of this drop? Could you see Tesla back in the 300s, maybe closer to about 350 again over the next couple of weeks? That is certainly possible, even with the increased odds of a recession in the background. I will go over why this is, what the data looks like, the option activity, what the short sellers are doing today. By the way, they're covering millions of shares. Thought you should know that at the start of this video. And what the data is this week that will be massively important for Tesla, but really for broader markets. And let's also establish one thing, first things first. The quote-unquote demand issues for Tesla, far overblown. Even the old Model Y is sold out in 29 states. Imagine what demand looks like for the new Model Y. I would imagine, given the demand for the old Model Y, the new Model Y demand is also, as Elon has suggested recently, insane, explosive, off the charts. Whatever terminology you want to use is fine with me. I would imagine that that is also the case in Europe as well as China. Even specifically in China, FSD just launched in the country. At the same time, the stock has fallen 55%, and it's going viral on Douyin, which is the TikTok version, or the version of TikTok in China, which you could argue could help boost sales in the country. Nonetheless, I think the bottom line here is the concerns about demand from Tesla are far overblown. And we're starting to see that. That's why Tesla did so well today. Also, yes, with the rumor essentially that the Trump reciprocal tariffs on April 2nd will be more targeted. They will be more quote unquote flexible. Some countries may not get tariffed at all. And it's really about the art of the deal. There will be some tariffs. There may not be tariffs on other areas or specific sectors. Although we did not get too much clarity today on who will be tariffed, what won't be tariffed, what will be or won't be tariffed, sector by sector, goods by goods, or country by country, it's a bone, if you will, for the markets. It is maybe the thought that Trump will not be as destructive on the economy as we previously thought. Because you could see with TLT today, TLT was down almost 1%. Even though less tariffs would mean less inflation, that should boost up bond yields. What Wall Street is saying today is less tariffs mean, yes, less inflation, but it also means the Fed won't need to cut as much. That the economy may not be in as much risk of potentially going into a recession. So the fact that TLT sold off today is fascinating. It seems like, again, the bigger concern by the markets right now is what's going on with the economy, not what the inflation picture is going to look like. And again, before we get into some of the more pressing info and, what's going on with shorts, option activity, potential short squeeze, gamma squeeze, all of that in the near term, and what ultimately I think comes from Tesla in the next couple of months, we did get some mixed data today. Global composite PMI, manufacturing PMI, and services PMIs generally came in better than expected. Manufacturing, there was some weakness. Services came in stronger. And even the Fed National Activity Index came in a little bit better than expected. Now, for services, that's what is most important because that is really the bulk of the economy. Now, output of the service sector rebounded sharply after hitting a 15-month low in February, driven by improved business inflows, strengthening consumer demand, and better weather conditions. But it's really the last sentence here that I I think is really overlooked by markets that could come back around to bite in the weeks potentially ahead. The last sentence here says, the last two sentences, it says, meanwhile, service sector confidence declined for a third consecutive month. So even though maybe the reported business activity got better, confidence declined for a third consecutive month, hitting its second lowest level since October of 2022. Businesses cited concerns over the impact of federal spending cuts, tariffs, and broader policy changes on demand and financial markets. So even though the report seemed kind of strong today, there's still this confidence issue. Now, recessions are confidence issues at first. They start with a confidence problem, right? If you're not confident you're going to have a job next week, for an extreme example, you're not going to go out and spend a crap ton of money. You're going to start pulling back. As that happens more on a collective or mass kind of basis, you could see how a slowdown starts, and then you could see how layoffs kind of start after that. Okay? That's the starting point of a recession. Now, whether or not we go into a recession or not, it's going to take some time before we know that. But the Atlanta Fed GDP Now tracker is tracking negative 1.8% GDP. For better or for worse, that is not looking good as of now. So I think there's going to be a lot of volatility no matter what happens with Tesla, no matter what happens in markets over the next really couple of months. This is not going to go away anytime soon. Now, with Tesla stock specifically, Tesla fell a lot fast. So you really got just beaten down in a short amount of time. So to see a recovery in which we really have not gotten one in 2 months, to see a larger recovery from here would not or should not be shocking to anyone out there. But it does not guarantee, even if we get back into let's say the 350s, roughly where your 100-day moving average is, that we're in the clear, that there won't be any more downside. That's not exactly true either. And it's really going to come down to what happens with the broader economy. And I will tell you, specifically heading into Friday, you're going to have big catalyst. Wednesday, durable goods orders month over month. There was a lot of front running in January via some of the expected tariffs going into effect. That's why January came in at positive 3.1%. Now, this is companies ordering inventory, right? Ordering things. From all indications we've gotten, consumer demand has been very weak, really, throughout Q1. So even though there was a boost in January, these numbers we're going to get on Wednesday are for February. You could see that ordering sharply pull back. So if it was positive 3.1% in January, you could see a similar negative number there as well to kind of be net neutral, maybe even more negative, like 4 or 5% negative on durable goods. Durable goods orders would not surprise me. The estimate is negative 1.2%. But again, don't be surprised if that number comes in really negative. That's your first set of hard data. Again, Jerome Powell made it clear. Soft data is shit. Hard data is good. Question is, does the soft data translate into soft hard data? And would that be something the Fed has to respond to? Well, we haven't gotten a lot of hard data since the soft data has started to weaken. So this week, it's really going to be reinforcing of maybe we don't get that weakening in hard data. Again, if the data is good this week. If it's bad, then it's really like an oh shit kind of moment, because at that point, it's going to be a lot harder to downplay the economic risks out there. With that said, Friday's your big data. Core PCE, obviously important from the inflation story. PCE derives its inputs really from CPI, PPI, and a couple of other factors in which we already have that data for. So it shouldn't be a big shocker, okay? We're expecting positive 0.3%, the same as last month. Personal income, not as big of a catalyst. You're expecting 0.4%. Personal spending is like the holy grail of catalysts for this week in terms of the economy, because consumer spending money is about 72% of the economy or so. If people continue to pull back spending, that's a problem. Now, you had a negative number for January, negative 0.2%. Based on the earnings calls that we've really gotten. That's I think what I'm judging this off of. Whether it's Dollar General saying consumers are slowing down, Walmart, Target, Best Buy, Nike, FedEx, name the company, they've warned about the consumer pretty much. I'm not super optimistic that February's number is going to be good. Now, what's fascinating here is the last time you had 2 negative months back to back for consumer spending was during the COVID crash. Yes, you've had negative numbers here and there. February 2021, negative. The next month, super positive. You had a negative number, March of 2023, negative 0.1%. The next month, it was really positive. Okay, so anytime you have these negative numbers for 1 month, the next month is really good. If that happens again, some of those recession fears are going to die down. If you get a negative number followed by another negative number, and you're going to have a bit of panic out there. So I don't know exactly what's going to happen. If I did, then I'd be in the Bahamas right now, right? Probably, logically speaking. Why would I be in Michigan? Okay. But there is the chance that this could go either which way and be a big positive or negative catalyst. And I bring this up at the beginning of this video before we get into some of the things that look good for Tesla, that are going right for Tesla, because there is the risk that later this week, things may not go as right for Tesla or for the broader markets. Now, option activity today was definitely strong. You had 269 different trades from hedge funds and institutions, totaling $290.51 million, with a positive order value of 75%. In terms of option activity, about 59% of the option activity was calls, 41.5% was puts. So looks good there. Look at this, 2.34 million shares today that are being covered on. Hedge funds and institutions are running out of their Tesla short positions today. That is a fantastic sign for what is to come ahead for Tesla. And all things considered, again, the short interest in Tesla is sitting at some of the lowest you've ever seen in Tesla's business history. Okay, so the whole time the stock's been falling, short sellers have been covering. And that is a positive sign in and of itself. Doesn't mean, again, the pain is over indefinitely for Tesla, but it's a good sign that hedge funds and institutions, they don't want to short the stock when it's already down 50%, right? They see the stock as, possibly primed for an upside move. Now, what's fascinating about today as well is the option activity is really kicking in again for this Friday's expiration. And I think that's why Tesla partly did so well today. Look at the volume numbers here. We're not going to have final open interest numbers probably until later on, tonight, or more likely tomorrow morning, to see how much of this option activity was simply just day trading, or if it was, options that were bought and held for this Friday's expiration. Nonetheless, 46,000 for volume at the 272.50 call, 65,000 for volume at the 275 call, 17,000 for volume at the 277.50 call, 66,000 for volume at the 280 call, 290 call at 40,000, 285 call at 30,000, 295 call at 20,000, $300 call at 73,000 for option activity for volume. These are some pretty big numbers, okay? If 25 or 50% of this volume translates into open interest, you're going to be looking at millions and millions and millions of shares that market makers may potentially have to buy by the end of this week. I mean, that's not, again, a guarantee of a potential gamma squeeze, but when you get this kind of momentum to the upside after a stock has been beaten down for so long, and the narrative starts to shift from having quote unquote demand problems to, wait, there's no demand problems. The Model Y is sold out, inventory sitting at the lowest levels you've seen in years. Oh my gosh, maybe we overreacted in halving the company's valuation. That could set you up short term for a pretty large rally in the stock. Again, mix that with hedge funds and institutions covering on short positions, and you could see how this situation could continue to get better from here. Again, keep in mind, nothing is a guarantee here. This is not a financial recommendation. You do as you please. But today, from a technical perspective, things are about as good as they could be. You gapped up above 250 today. You really opened at, where's the opening? 258.08. So well above 250. Within the first couple of seconds, you were above your 20-day moving average. That was the first level to really be watching for at 258.92. It was about 259 in the beginning of the trading day today. And then what happened? Well, you went all the way up to about that 275 level, got a little bit of resistance there, and now you're even above your downtrending trend line, or which was an uptrending trend line, which connected the lows of April of 2024, the low of August 2nd, August 5th of 2024, the low of October 13th, 2024. Next day later, Tesla was up 21%, by the way. And this gap down level you had on March 7th. Now you're back above that level again in just, what, $14 away or so of your 200-day moving average. The 200-day moving average is going to be a big test, okay, from a trading perspective, technical perspective as well. If you can get above that 285 level, that 200-day moving average, you have a pretty clear shot into the 300s. 310 is my next level above the 200-day moving average, and then 325. But if you can get into the 300s, it wouldn't surprise me if you could extend your 50-day moving average or even your 100-day moving average, 50-day moving average at 333, and your 100-day moving average at 347. To get up to that range would not surprise me at all. In fact, I've been actually shocked that Tesla was oversold for a month and didn't rally. I mean, normally when Tesla gets to 30 on the RSI, you have a very violent short-term rally, but especially when you're oversold for an extended period in time, you tend to go through some pretty aggressive rallies, right? Which you just have not seen that yet. Even back when everyone was scared that, Elon wasn't working at Tesla anymore and was selling a bunch of Tesla stock, and Tesla was actually cutting prices of their vehicles to, kind of boost demand, Tesla was a $101 stock. When it got oversold and was oversold for about a month, the stock ended up rallying 115.5% over the course of the next 5 weeks, 6 weeks or so. Now, I don't know if we're going to get a 100% rally from here. That would put the stock back to new all-time highs. Could you get a 40%, 50% rally? I wouldn't count it out. I wouldn't say it's impossible by any stretch of the imagination. A 40% rally from here, going to put the stock to about 303, 304. 50% rally from the lows would put the stock, hey, what do you know, at about $325 per share, a little bit more than that, maybe about $330 per share. Is that a possibility? It is. And I do think FOMO will start to come back into the stock if the price action continues to improve and or we start to get continued positive news. The fact of the matter is, we've really only gotten positive news for Tesla, like FSD launching in Mexico and China, you name it. There's been so much good news. New Megapack factory launching in Texas this year. Shanghai Megapack factory finished construction, is now starting to actually produce units. There has been a lot of good news that has been ignored, and maybe it's a resurfacing of sorts of some of that good news that was ignored because of all of the quote-unquote demand concerns or Elon's political affiliations and what have you not. So that's where I'm at right now. I don't know if this is the lows, right? I don't know if 215 were the lows. It really depends on the economy and a recession. It's 50-50 in my opinion. Do we go into a recession or not? If we don't go into a recession, 215, very, very likely that was the low. Okay. 50% chance in my book. If we go into a recession, 50% chance of that as well, then it wasn't the lows. And that's why this is a very hard market, because it's difficult, because you don't want to be all in You don't want to be all out. You don't want to have too much exposure, so your downside could be massive if we go into recession, but you don't want to have so little exposure that if we go to new all-time highs or if things go back to normal, you don't benefit from that. So it's a very, very, very difficult market. I think this is probably the most difficult market that most of us have ever seen. And I think, there's obviously a good chance it could get even more difficult. There's a lot of speculation about pre-announces that could come out here this week or maybe over the next couple of weeks that could be really negative, show margins are taking a hit, kind of throw into question what EPS is going to look like this year for the S&P, and so many other just things that are changing day by day, tariffs being one of them, where there's a lot of uncertainty. And that uncertainty is starting to affect the broader economy. And that is, for me, a cause for concern. Again, not to sell everything, but to think about things a little bit harder before decisions are made. So, again, nothing is a guarantee, but I could see Tesla moving higher as long as the data continues to cooperate. Let me know what you guys think down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.